All right, everybody, welcome to another YouTube video today. So today we are going to talk about why dividends are not free money. But before I go into detail and piss some people off, 4 simple things I want you to do if you are getting value out of my channel. Number 1, hit the like button. That's easy to do. Number 2, subscribe to the channel. 3, hit the bell so you get alerted every time I release a new video. I've been trying to do about 1, maybe 2 a week. And lastly, share it with your friends because everyone needs more personal finance education. And that's my whole goal with YouTube. It's just to share my knowledge, share what I know, and do it in a way that makes it easy to understand. And so I want to talk about why dividends are not free money. And before I go into that, let's start with what is a dividend? So if you have a company, okay, and you have this company here, right? And the company decides, hey, we're going to pay $1 a share. So we're going to say $1 a share in the way of a dividend. Okay, simple enough, right? So the company is going to pay $1 a share to you. All you have to do is hold the stock. And they'll say, hey, this is going to be our ex-dividend date, which means that you have had to own the shares before that date to get credit for the dividend. And so what happens is, let's say you over here, you're all happy, you own 100 shares. It looks like a 7, but it's really a 1. Okay, so you own 100 shares of the stock. You're like, okay, I'm going to get $100, right? $1 a share. You're going to get $100. Okay? So all you have to do is hold on to that stock through the ex-dividend date, and then you will get $100 in your account. Cash. Now, you're like, well, that's free money. That's passive income, baby. I didn't have to work. And you're right, you didn't do anything for it, right? You didn't have to do anything for that money. All you had to do was hold the stock and you got the money, right? That's right. So you're like, well then Matt, you're full of crap. Your video is a joke. You're a joke. Why are dividends not free money? Well, let me explain it in accounting terms. So in accounting, you have this equation, which is assets equals liabilities. I'm not right, equity. Assets equals liabilities plus equity. If you take any kind of accounting class, you know this by heart. If you haven't, there you are. So now I can rewrite it and say, what's my equity? Is going to be assets minus liabilities. And so you have a balance sheet. Your assets are what you own. Liabilities are what you owe. Okay? And so what you're left with is your equity. Think of equity like the net worth of a corporation. We'll say, like you have your net worth, like you're worth, if you have $2 million of, assets and you have $1 million of debt, your net worth is $1 million. So just think of this in that way for a corporation. And that's exactly what this essentially is. And so I want to focus on the equity piece, because in equity, so let's focus on equity. Let me raise this up here. Let's focus on equity because this is important. So we remember it's assets minus liabilities, but there are components. Let's talk about the components of equity. And I'm not going to cover every single one, but a lot of times you have common stock, and that has a price. There's going to be paid in capital. And so I don't want to make this an accounting lesson, but so these are like when a company issues stock, it'll have some kind of value associated with the stock when the minute they issue it. That hits your balance sheet. Paid in capital is above and beyond that. But again, these are just the basic building blocks. The one that you have to pay attention to is, and this is where dividends are going to hit, retained earnings. Forget everything else. This is where I want to focus on for dividend investing, because this is the key point here. Let's focus on retained earnings, because it is a component of equity, and it's an important component when it comes to worrying about dividends. Because what retained earnings is accumulated income. And think of it like this. So let's say you start a business and you're at zero, your retained earnings are zero. First year, 50K income. That goes into your retained earnings. You have 50K now. Your second year, let's say you have a 10K loss. Now your retained earnings is 40K. Third year, 100K income. You can probably guess, 140K. So it's like accumulated profit. Does this make sense? So I start at zero, and then I get my $50,000 of income, and I build it up to 50. Then I have a 10K loss, and now I'm down to 40. And then it goes up to 140. So it's just accumulated earnings over time. And so every year, you have net income that rolls into retained earnings. So it's built up. So you're probably like, well, get to your point, buddy. What's going on here? Well, so let's say that company, so we have $1 a share dividend, and let's say there's 1 million shares. Okay? And let's say the retained earnings, I'm going to put an R/E for retained earnings. Let's say that is $10 million. Okay? So they declare that dividend. Okay? So now there's a payable. Like, I have to pay these dividends out. They come from retained earnings. So if this is part of my equity, this $10 million, and now I have $10 million, but now I have to pay out $1 million in dividends, my equity has been reduced. And I didn't talk, let's just say, I mean, obviously stock's going to have some kind of value, but let's say the value of the stock is nominal. A lot of times it is, it's teeny tiny amount. My equity just dropped. In fact, we'll make up some numbers. Okay? We're just going to say, we'll say that, let's say here, okay, let's do this. And I want to illustrate my point. So in equity, let's say here's your stock value. Okay. Let's say here's retained earnings. It's 10 million. I'll probably regret that because the math is going to be difficult. Okay. So your total equity is now $11 million. So you come along, and this is what drives the value of the stock. What you're buying a book of business. You're buying equity. You're buying the company's net assets here. You're owning a business. And so let's say they have 1 million shares of stock. I don't know. Shares. Okay. So the value per share is 11 million divided by 1 million, which is $11 a share. Right? Do we all agree on that? It's $11 because my total equity is $11. I have 1 million shares. Done. Okay, so now, though, I'm going to pay this dividend out. I'm going to pay $1 million dividend. Okay, so now we know we're $11. So now I have a dividend. So now I'm down to $10 million of equity. So your share price is now 10 million. And I know I'm writing crooked. 1 million. It's $10 per share. So they paid you that dollar a share dividend. But the value of your shares has decreased by that amount. And that is why dividends aren't considered, in my opinion, free money. Now, you're like, okay, I see your point. But then why do you invest in dividend stocks? Why would you even do it? And so let's ask yourself, why invest then in dividend stocks? So the first answer is the best use of money by a company. And so here's the deal. At the end of the day, when a company makes a profit, they have to decide what to do with this income. And number one, they can reinvest it back into the business. Maybe they allocate some of that to R&D to further grow their business. The other thing they could do is buy back their shares, which means they're going to buy some back of their own. They're going to buy some of their shares in the market, which raises the value of your shares. Sorry about that. But the other thing too that they could do is they can issue these dividends. And that's a company decision. They have to figure out what the best use of capital is. And there are a lot of companies, that do this. They're more value focused. So what do I mean? If you look at, a spectrum here, a lot of times you'll hear people talk about growth, and you'll talk about value. And there's usually a spectrum here. People talk about growth stocks versus value stocks. Value stocks to me are ones like P&G. They're slower movers. They pay dividends. FedEx, Kellogg's, Hanes, ones like this. You're gonna buy at a lower multiple of profit. So in other words, the profit price to earnings. I can't even talk. The price to earnings ratio on these are going to be a lot lower because they're slower growth companies. They're not growing quick. A lot of people in the market, in Wall Street, all the analysts don't expect them to grow quick. So these are just going to be your reliable value companies. They're very profitable, and they take some of those profits and pay them in dividends. And a lot of people like it because I get this check and I don't have to do anything. I can hold my shares, and over time the share price will go up because of the compounding. So you have this side over here, and then you have growth, which is going to be, Apple's probably kind of in the middle. But then you might have a stock like, DraftKings, these are extreme. Tesla, stuff like that, where they're expensive, they don't have a lot of profit, you're paying a lot, but the expectation is they're going to grow really quick over the next several years. So this is kind of why a lot of people like dividends, because you're focused more on these value-oriented stocks. They're going to be more stable. They're not going to go up and down crazy with the market like the growth stocks will. And so that's generally why people like them. And also, so you get value focused. don't need to touch principal. You don't need to sell shares. The dividend check comes, that's your income. You don't have to do that. Another reason people like them, it's favorable tax treatment. So favorable tax treatment for these, if you meet the qualifications for the dividend to be qualified, which I believe is like you have to hold it for, oh my gosh, I don't remember off the top of my head. I want to say it's either I think it's 60 days before and after. I might be off. It might be 90 or 120. So don't hold me to it because I don't have the number remember off the top of my head. But anyway, you can look it up. But if you hold the stock, if it's a U.S. corporation or a foreign corporation that trades on the U.S. stock exchange, and your broker will break this out, but qualified dividends have a favorable tax rate, at least as of now in 2022. Who knows if it'll stay, but they do. And so if you put them, their dividend stocks can be great in a taxable account because those dividends will get better tax treatment. And so that's a point to keep in mind. But again, I think a lot of these points, they all come back to, I think the biggest draw for a dividend is because of the type of companies that you're getting with that dividend. They're not going to be aggressive growth companies. Aggressive growth companies have lower profits. They're going to use any profits they have to reinvest in the business. But dividend companies, they're profitable year in and year out, very reliable, and they're going to be slower growth. And that's why people like those kind of stocks. So I want you to understand that at the end of the day, the dividend does not, at first glance, increase the value of your shares. But what you can do is you can reinvest. So my last example, assume that you got the money in cash. And that's it. You got the cash, you go and spend it, whatever you want to do with it. So let's do this example again. And let's say here you are. You have your 100 shares. And what did I say? There was we're just gonna make up a number here because I'm not gonna go off the old example. Let's say $100 per share. Okay, so the value is $10,000. That's the value of your investment. 100 shares, $100 per share, $10,000. All right, so now I go in here and I say, okay, I'm going to get $1 a share dividend. Okay, so now what happens is I get 100 shares times $1 equals $100. And you're like, cool. Now let's assume this stock price does not change. Assume it doesn't change, it stays the same. So now what do? We go in here and we say, okay, I'm going to reinvest these. I'm not even going to take the cash. I'm going to go and buy 1 share. Right? I'm going to go buy 1 share. Automatically done. So now next quarter I have 101 shares times $1. I will get $101. Now, you're like, let's just assume market is flat, perfectly flat, which we know is not realistic, but let's just say it is. And now I can buy 1.01 shares because $100 a share. So now next month I have 102.01 shares times $1. You can see how doing this quarter after quarter after quarter after quarter, it will add up quickly. And this assumes 2 things that probably will not happen. The share price stays the same and that dividend stays the same. Companies over time will increase their dividend. Share price also tends to increase. Now, what you want in a perfect scenario is you want that share price to take a dump right when that dividend gets paid so that you reinvest at a lower price. Sometimes that happens, sometimes it doesn't. But over time, that dividend keeps coming in and it builds these up, and it can build these positions up very nicely over time. So that is one of the cool things about a dividend stock. I just want people to understand that at first glance, when you get paid a dividend, the net book value of the share, the net value is reduced. And like I said, I walked through the balance sheet to show you that. So hopefully you got a lot of value out of this video. You enjoyed it. If you have any questions, drop them down below in the comments, or you can send me a message on Instagram at mdeep, that's MDEEPECPA, all one word, or at Twitter at mdeep_CPA. Have a great day.